regardless of what one's political stance may be. Okay, whether you're for or against, that doesn't matter here. This is just about the tax code. So I want to just educate people on what the tax code says and what we need to be thinking about to take advantage of what they're giving us. Okay? Because part of our mission statement is to empower people through financial education. So we're big in helping people understand how to read their tax return and how to understand that by changing numbers that flow through to your tax return, how that it can impact you both positively and potentially negatively so that you can make an informed decision. So this one big beautiful bill, lots of changes, lots of things staying the same, but it's important for us all to understand what's going on with it. So first and foremost, we knew that before this big beautiful bill passed, okay, there was the chance that we could have a major tax revision or retraction back to the way things used to be prior to the first big tax bill that was introduced back in 2017. So the first thing that this bill does, it made the tax brackets permanent. Now, let's get this clear. Permanent is not permanent because the tax code always changes. It's, well, wait till the next administration, right? It's permanent as long as the current administration's in, okay? If another administration gets in, everything can change. But what we've just done is we bought ourselves through 2028 where we know what the rules are. So what are the rules? Well, we still know we get to enjoy a favorable tax code of 10%, 12%, 22, 24, 32, 35, and the max tax bracket's 37%. Now, just to give you a little bit of context here, the max tax bracket in U.S. history was over 90% right after World War II. Okay? When the tax code first started, it used to be a flat tax of 13%. Okay? And it's been all over the board since then. So just like the Michigan weather, if you don't like it, just give it a few months or years and it's going to change. But with the way it's structured right now, okay, there's a lot of things that we could take advantage of. First of all, for those people that are looking to want to take some tax liability off the table for future generations or maybe for themselves down the road, there's a wonderful opportunity to be doing Roth conversions right now. And remember, there's no income limitation on the ability to do Roth conversions. So unlike the limitation to do a Roth contribution, no income limitations on conversions. So right now, with the tax bill being extended and the brackets increasing with inflation every year, you can have about $400,000 of adjusted gross income and still be in the 24% bracket. How many of you, if you were walking down the street and you just took a stranger and said, you know what do you think my tax bracket would be if I had adjusted gross income of $200,000 or $400,000? What do you think the average person on the street would say? They say, oh man, because we all hear how bad taxes are. Say, oh my gosh, you must be paying 50%, maybe even higher. Folks, max tax bracket, $400,000 adjusted gross income, 24%. And guess what? Not all your income's subject to the 24% bracket because we still get the benefit of the 10%, the 12%, the 22%, and the 24% bracket. So some of your money may be taxed at 24%, but when you blend all the tax brackets together, you're about 20%. And I would say for most people, if you were to say, hey, I got 400,000 adjusted gross income, effective tax rate of 20% really isn't that bad, is it? We need to be taking advantage of these things. But what does that mean? We have to be proactive, and we need to be thinking these things through and taking advantage of it while we are in this season. Because just like any season, they will pass. And if you have $36 trillion of debt, guess what? They're going to be looking for tax revenue at some point, somewhere down the road. And so the favorability of what we know as this permanent bill, it's going to most likely change. So folks, the first thing that we need to know is understand what this bill has, but also how do we take advantage of it now and perhaps take some tax liability off now that we would potentially have in the future in a much more potentially punitive tax environment down the road. So again, tax brackets made permanent at least until it changes again. Okay, standard deduction. This is a huge benefit. You know, when they were talking about the one big beautiful bill, one of the things that they wanted to do is they wanted to not tax Social Security. Well, that didn't get passed, but what they were able to do is for those seniors who are over the age of 65, they added an additional $6,000 that you could take as a deduction on your tax return. Now, this is in addition to the standard deduction. So the interesting thing is the standard deduction for our senior clients, anybody that's over 65, okay, so let's just take a married filing joint couple. If you're under 65, it's $31,500 standard deduction, which means you just don't have enough mortgage interest, state income tax, property tax, so forth. You just don't have enough to itemize, so you get the benefit of the standard deduction. Okay. Well, one of the things that it just gets harder and harder, especially as you get older, to be able to itemize, just because you don't have the mortgage anymore. You don't, you're not paying as much in state income tax anymore. So many of our older clients over 60 just are only able to take standard deductions. So now, if you are married, filing jointly over the age of 65, you not only get the $31,500 that all the other married filing joint couples get, you get an additional $2,000 just because you're over 65. So that brings you to $33,500 right there. And then they've added $6,000 each to your deductions. It's like, holy smokes, that's over $46,000 that I get to deduct right off my adjusted gross income. And when you factor that not all of your Social Security is subject to tax, some people, they have none of their Social Security subject to tax. Other people, because they have other provisional income coming in, such as wages, interest, dividends, IRA distributions. It's provisional income that causes your Social Security to become taxable. Some people, they have up to 85% of their Social Security becoming taxable. Either way, that additional $12,000 of deduction comes right off of that. So now you're saying, wow, you know what? For some people where their taxable income was $80,000, well, now with the extra $12,000, it's now $68,000, of which the first $20,000 is taxed at 10% and the balance taxed at 12%. I mean, your effective tax rate's almost nothing compared to how much income you were bringing in, right? So the real key here is, how do I take advantage of this additional deduction? Especially, again, going back to Roth conversions, if I got room to convert more money and still be in the 12% bracket, maybe I should. Even if I don't need the additional income, maybe it makes sense in this window of opportunity between now and 2028, while we have these benefits, maybe I should bring in additional $30,000 of income, either as a distribution. Maybe you want to take the kids on a family trip somewhere, and this is a great excuse to do so. Part of your living legacy. Or maybe it's, I don't need the money. Let's convert this money. Let's take advantage of the taxes being really low so that if and when potentially the tax code gets more punitive, I have more tax-free dollars available that I can access down the road and or leave to my children through my estate plan. So huge opportunity, especially for those people over the age of 65, to get that additional $6,000 each in deduction. In addition to that, if you are in the service industry and you get tips, and that's part of your normal compensation. We know a lot of employers, they give a very low hourly rate with the expectation that tips is going to make up the vast majority of the rest of your income. Well, tips, you're supposed to claim your tips, right? Now, some people are better at claiming tips than others. I mean, that's just the nature of that industry. But now, what they have done with the big, beautiful bill is that starting in 2025, so this is effective immediately, if you get tips, you get to deduct $25,000 of those tips right off your return that you don't have to pay taxes on. Now, I don't have a ton of people that that get tips for a living as part of the service industry, but I do have some. And I will tell you this, when we did the calculation as far as what their taxes were before this went through and then what after it went through, we're talking about thousands of dollars that they're getting of money that they were going to have to pay out that they're not going to have to pay out. What an opportunity, right? To maybe put some more money into a retirement plan. Maybe they take some of that money to convert it to a Roth. Maybe they're able to increase their standard of living. Regardless, anybody that's in the service industry needs to be aware of it. They probably are, just because it was a big part of the bill. But you need to sit down and talk to somebody who says, how does this really impact my bottom line, right? The other big thing is overtime, right? You know, we got time and a half. So now what they're doing, retroactive to January 1, 2025, is they 50% of the 1.5, right? So straight time still subject to tax. It's the extra 50% that they're giving over straight time is not going to be subject to tax. Now, a couple important things to know is that there are some phase out limits on this. So if you make too much money, you might not be able to take full advantage of this bill. But I would anticipate that a lot of people in the service industry, so forth, you know, the phase out limit's so high that the vast majority of them are just not going to be impacted by the phase out limit. So if you're in that type of situation, absolutely, you need to be speaking to somebody about getting some financial guidance and understand what the benefits are, because maybe you're paying in more in taxes right now than you need to because you don't have to incorporate all this additional income into your overall calculation. The SALT deduction is extended. What is SALT? State and local income taxes. Part of the original bill that passed in 2017 limited how much we could itemize on your tax return. It's just Schedule A. The Schedule A is where you list out medical expenses, property taxes, state income taxes paid, mortgage interest, charitable deductions. And if all those deductions exceeded your standard deduction, you were able to take more dollars off the tax return, right? Well, one of those big expenses that was limited in the original bill that was passed in 2017 was a state and local tax deduction. They capped it at $10,000. Which means for a lot of people, their expenses were a lot more than $10,000, especially higher income earning people that may be in the hundreds of thousands of dollars number. Well, they're paying a lot in state income taxes. And it's not coincidental that higher net income earners probably have bigger real estate holdings, which means they have more in property taxes that they have to pay. So I know people that their property tax well exceeds $10,000. So now they were capped based on the prior legislation. Well, now that cap has been extended, so now it's $40,000, which is going to help a lot of people to be able to deduct even more on their tax return. Now, just like anything else, there are income and phase-out limits where if your income's too high, it stays at the $10,000 level. But I would say for most of our middle income to upper income clientele, people that are doing relatively well, that are paying a lot in taxes, this is going to be a really big benefit for them to reduce their overall tax situation. So the estate tax exemption has been increased. Now, for most people, this is not going to be a big deal. It's increased to $15 million per person. So if you're married filing jointly, you can leave up to $30 million without any estate tax, only if we all had that problem. But unfortunately, 99.5%, maybe 99.9% of us don't have that problem. But if you are that 0.1% that may still have that problem, we would love to talk to you, by the way. Okay, but so not necessarily a big thing that impacts the vast majority of the people here. But here is a benefit that does impact a lot of people. It's the auto loan interest deduction. Back in the day, we used to be able to deduct our credit card interest, our auto loan interest. We deduct. I mean, we had it made back in the day. Well, they took a lot of that away. And of course, when you take away people's deductions, it's an automatic increase in your overall tax. It's and a lot of people just don't think of it that way, right? So that's why when we get older, we don't have the child tax credit. We don't have the mortgage interest. So a lot of people end up paying the same amount of taxes in retirement as they did when they had a young family, because they had so much more in deductions than what they have in retirement. But this is something they brought back, and this is something that can really help a lot of people. It's a temporary deduction for auto loan interest. It's up to $10,000 per year, but only on new personal use vehicles assembled in the United States and purchased between 2025 and 2028. So, couple key words there. They have to be new vehicles. They have to be used for personal use. So you can't say, hey, I'm a business owner. I'm just going to buy this $100,000 vehicle. I'm going to use it as a write-off, and I'm going to be able to write off the end. No. You can't do that. Okay. But if you're in the market to buy a new vehicle, or maybe you were in the market before to buy a slightly used vehicle. We got a lot of people that say, you know what? I never buy new. Okay? And because I'm just not willing to take that depreciation right off the bat. Well, if you're going to buy a vehicle that's a year old, maybe 1 year less in warranty, and still finance it, maybe it does. Maybe this swings the pendulum back and say, you know what? Maybe we will buy new, because now we can deduct up to $10,000 of this interest off our tax return. And if we're in the 22% bracket, that's $2,200 of federal income tax savings on our return. You know what? Maybe that's what just pushes you over the edge. But it's really important for you to talk to your dealership when you're doing the purchase of this vehicle, and to find out if the car meets all the criteria necessary to get this tax deduction moving forward. Clean energy deductions are phasing out. So if you were planning on doing any big home improvements, they need to be done by the end of the year if you want to get some clean energy tax credits. There's stuff in here for business owners, depreciation, qualified business income deduction. If you're a business owner and you want to see how this directly impacts you, I would encourage you just to come in and talk with us because there's so many unique things I just don't want to get into right now. That's over probably 95% of the people that be watching this. Come in and talk to us, or certainly your CPA environment relationship, and make sure you understand some of the benefits of the One Big Beautiful Bill for your business. So in closing, there's a lot of opportunity here. You know, prior to the legislation getting passed, we were worried that the tax code was going to revert back to the way it was prior to the original 2017 bill passing, which means everyone's tax bill would have gone up significantly. With this additional bill getting passed through, we now know that we have some certainty through 2028 that we are going to understand what the tax environment we're in, and it's going to continue to allow us and our clients, and hopefully you, whoever's listening to this, the idea that said, boy, I just bought myself 3 extra years where I can be proactive. Don't put your head in the sand and say, well, you know what? I got time. They're not going to change it because they made it permanent. You got 3 years. We don't know what's going to happen, folks. We just don't know. Things are changing all the time. Take advantage of the way things are now. Understand how to read your tax return. Understand what happens when you add money to it, when you detract money from it. And then you can make an empowered, informed decision as to what is important to you during your lifetime so that you can live the best life possible, paying the least amount of taxes based on a plan. Taxes aren't bad. Overpaying your fair share is bad. And remember, there are 2 tax systems in the United States. One for the informed and one for the uninformed. Both are legal. Take advantage, become one of the people that's informed so that you can save those tax dollars so that you can either increase your standard of living, give more generously, or be pass on even a bigger blessing to the people that you care about.